When I was on the hunt for my first rental property, I was looking to purchase an investment that had a little something called equity on the buy. Above the monthly cash flows that came with this rental property, I knew for a fact that there was roughly $40,000 or even $50,000 of raw untapped equity on the buy of this property because it was being severely underutilized and undervalued in terms of the market and the neighborhood surrounding it. And this concept of equity on the buy is what you need to understand as a real estate investor, as it's going to be a really powerful tool for your financial freedom. Hey, what's going on everyone? My name's Griffin and I hope you're all having a really great day and that you're putting concrete steps into action to achieve your goals in 2020. So in today's video, we're going to be speaking about home or property equity, what it is, how you can build it, and how you can utilize it to leverage yourself into more properties or real estate deals in order to grow your wealth and overall portfolio, which I hope is of interest to you because, well, if it's not of interest to you, then I don't know why you're watching this video. Now, the reason why we're speaking about home equity in today's video is because I had a couple people reach out to me directly following my previous video about having purchased my second rental property in 2019. Great video if you haven't already checked it out, but there was a bit of confusion as to what the home equity is and how it's built and why I included it in the calculations for my return on investment with that property. It is absolutely critical that you properly understand what equity is if you're looking to purchase a home or a real estate investment in the near future, because in most instances, and I can't make a blanket statement here for every single deal, but for the most part, cash flow is really great on a property. It's going to allow the property to throw off cash each and every month that you can utilize or reinvest into more properties. But for the most part here, equity is really where the most wealth is created in a real estate. So equity on the buy, as well as equity that you're building up through loan pay down throughout the course of your ownership of that property. Okay, so I've thrown the word equity all over the place here in this video, but if you're here because you want me to explain to you what equity is and how you can utilize it, then this isn't the right video for you. No, I'm just joking here. Let's actually go over what equity is right now so that for the rest of the video, you know what I'm talking about when I'm speaking about tapping into your equity to fund future deals. Jumping right into it here, let's say you went out today and purchased a rental property or a home that had a market value that you paid for at $100,000 and you decided that you were gonna put a 20% down payment on this property. Well, that means that right out the gate on this property, you're gonna need to go to either a credit union or a financial institution and get an 80% loan on the value of this property, meaning that in this particular case, this deal will have an LTV or loan to value of 80% at the time of purchasing this home. So basically the equity is the gap between the market value or what you paid for it and what you owe on the property, which in this case is 80%, so $80,000, and your equity, your position in this property is, you guessed it, $20,000 or 20%, which was the down payment that you put on the property. Now let's say fast forward here, you've owned the property for 10 years and every single month you've been paying your mortgage payments, which I would hope you've been doing here. Well, that means that every single month you've been building equity in your property, because with a mortgage payment, you're paying chunks of it that are your equity, but then also mortgage interest. But every month you're building equity in the property. And let's say you've brought your loan down to now 65% from the total value of the home. Well, that means that you have an equity stake position of 35% in this property. You know, it is relatively different than owning shares in a company, but I'll just make a quick little comparison here because we like to speak about stock market investing on this channel. If you were to go out and buy, let's say 10% of the shares of Apple, well, theoretically there you would have a 10% equity stake in Apple computers. And if you wanted to sell all your shares in one single lump sum, theoretically you could go and get 10% of the market value for Apple computers. Now, in this particular case though, with real estate, your equity stake, because most of the time you're always gonna have a mortgage here, is gonna be the difference between the market value and what you owe on the property. And if you don't have a mortgage, you own the property outright, well, your equity stake is 100% in the property. For this reason, I absolutely include include equity when I'm doing calculations for return on investment of my rental properties, because even though equity isn't liquid cash that I can utilize to go and say buy milk and eggs at the store, well, this equity is still being built over time, and as the owner of the asset, I am entitled to this equity on sale of the property. Now here comes the fun part though with real estate investing that you can't really do as easily with any other type of investment such as stocks, ETFs, or commodities like gold and silver, which all pretty much just go up in value based on a variety of factors, mostly supply and demand, company financials, and overall speculation of where the company is going to go in the future, which are all factors that are unfortunately out of your control as the investor. As a real estate investor, you can go out and search for properties that are being sold under market value or that are being underutilized in terms of renovations, the overall just look and feel of the place, or even the rents that are being charged to tenants for each one of the units in the apartment complex or the duplex, let's say. And then you can buy the asset knowing that it's actually worth significantly more. You do one of the renovations or you raise the rents as mentioned previously, and then the asset is actually worth significantly more than what you paid for it, thus creating equity on the buy. If you go ahead and sell a property that you own, well, on the sale of that asset, you're going to get back all the equity that you either put into the deal or that you built up throughout the ownership, starting with number one, the down payment, which is equity that you're putting right into the deal on the purchase. Number two is going to be the equity that you've built up every single month from your mortgage payments as you're paying down your loan. And then number three is going to be that difference of equity in terms of the market value when you sell and what you purchased it for. So if it went up by $50,000, you're going to get that $50,000 of equity in cash on the sale of your asset. For example, okay, the first duplex that I purchased over the summer, I'll be honest here, it was in rough condition. It had broken windows, it had molding on the flooring, the outside looked extremely dated, it hadn't had any TLC in like 10 years, honestly, and there was a huge hole in the ceiling that the tenants had to live with. Bottom line, it was in really rough condition. From though the perspective of an investor who wanted a turnkey property that could just collect rents and then call it a day. However, due to the condition of this property, both inside and outside of each unit, the rents were also reflective of this, being significantly under market value at about $675 per 2-bedroom unit in this duplex. And I knew going in though that the renovations total would cost only about $2,000 because they were pretty much just all aesthetic, and it would be a lot more just some sweat equity and time spent renovating the property myself. And so for this reason, we'd be able to bring up the rents to market value in that area, which is about $800 per month per 2-bedroom unit. That's exactly what we did, and therefore the overall value of the property also increased, thus basically just creating equity out of thin air. When I purchased this duplex over the summer, the seller was himself undervaluing the asset that he had, so I was able to pick it up at about $182,000, and I knew going in though that I could put in those renovations and some sweat equity, bring up the rents and overall the value of this property, and that's exactly what was done here. And right now with the new rents and the renovations, if I were to get it refinanced, I could probably get it for around $250,000, meaning that on the buy of this property, there was about $50,000 to about $70,000, depending on the value I'll get it reappraised at, built into the buy of this duplex. This is actually a strategy that the guys over on Bigger Pockets call a BRRRR, or BRRRR, which is actually an acronym though for buy, renovate, rent, refinance, repeat, and is a way that real estate investors can create massive amounts of wealth in a really short period of time. With my first duplex here, even though it was a really good deal and I made some significant equity on the buy, well, bottom line, it's still a relatively small deal with small numbers, but this strategy can be applied to a variety of different rental properties, from commercial real estate to larger apartment complexes or just larger multifamily units. The choice is yours and the possibilities are basically endless. I really hope that this example of my first real estate deal was able to better illustrate to you how you can purchase a property with equity built into it, and how over years of investing in real estate, you can really build up some massive amounts of equity and wealth. All right, so now that you're an expert and you fully understand what equity is, why is equity so important, and how is it that equity is what creates the most millionaires in real estate? Let's take a look at how you can tap into your equity in your home or in your real estate investment portfolio in order to leverage yourself into more properties, more deals, and overall just exponentially grow the overall portfolio that you have in real estate without having to always penny pinch in order to save up enough money for another down payment on another property. This is actually what I personally plan on doing with my investment portfolio moving forward, so make sure you give this video a thumbs up because I'm pretty much giving you guys my overall investing strategy from stock market investing to real estate investing. But you know what, whatever, if this benefits you guys, then it's worth it. Please keep in mind here that everything we're about to cover for the rest of the video is related to tapping into your home equity or the equity that you've built up in your rental properties in order to leverage yourself into more deals. But I'm personally not your CPA, I'm not your financial advisor or your mortgage broker, so before that you take anything on that we're about to cover, make sure you consult with a financial professional. Okay, so there's a variety of different ways that you can utilize your home equity in order to fund more deals or leverage yourself into more deals or pretty much just get cash out of your properties. But obviously, in order to cover every one of these, this video would be like 10 hours long, and I don't think anyone wants to watch a 10-hour long video. If you do, well, I'm flattered, honestly. But basically, there's three main ways here that you can materialize some of your equity that's tied up in a property in order to utilize it to go into more deals. The first one here, quite simply, is on the sale of a property. So if you purchased a place for $100,000, let's say 5 years ago, and in that time it went up to a market value of $200,000 and you still owe, let's say, $50,000 on your loan, well, this is gonna mean that when you sell the property, your equity or your stake in the place is $150,000 minus some of the seller fees and the taxes, but nonetheless, this is awesome. But what if you don't want to sell this property, right? It's either your primary residence, you're happy where you live, or it's still a cash flowing asset that's building equity, you're happy with this deal, you don't want to sell it. Well, is there a way that you can tap into this dormant equity that's just sitting there, basically just doing nothing, that you can utilize this equity in order to fund more deals? Obviously, yes, there is. And the first one, which is quite common and is probably not new to you if you've been a homeowner for quite some time, it is called the home equity line of credit, acronym HELOC, which is commonly used. And basically, this is an agreed upon line of credit that you've agreed upon with a credit union or your financial institution, which basically uses your home or the equity in your home as collateral against defaulting on payments from equity that you're borrowing against in your home. I know this kind of actually doesn't sound like a good thing. If you default on those payments, the bank can take back your home, but hear me out for a second. Let's say, for example, you owned a piece of real estate that had a market value of $200,000 and you currently had $100,000 in equity built up in this property. Well, theoretically here, you could go to your financial institution and get a HELOC on your home, which is gonna tie up a portion of the equity in that home, a portion of your $100,000, and then you can borrow against it up to that certain amount that you agreed upon with the financial institution. And every situation here is gonna be different, so make sure you get well informed and you inform yourself with the bank. And oftentimes in the terms of your HELOC, you can actually just go about paying back the interest for a set period of time before you have to start paying back the principal that you borrowed from your home. And obviously, even if you go and get a HELOC of, let's say, $50,000 that's tied up with the equity of your home, well, if you only use, let's say, $1,000, you're just gonna pay interest on that $1,000 chunk, just like with a credit card, for example. But the main difference here is that with a HELOC, because your funds are tied up with an immovable, so your home or a real estate property, well, the interest rates are typically much, much lower than conventional personal loans or those dreaded credit cards. So if you're new to this concept, then honestly, think about it for a second. You can tap into the equity of your home or your rental properties that are just sitting there doing nothing with a home equity line of credit. And hopefully though, you're not gonna go and, let's say, buy a new Mercedes. You're gonna use it in a strategic strategic way in order to expand your portfolio and your holdings, but this is just a concept that I really want you guys to understand because there's a bunch of different ways you can utilize equity in real estate. The second most common and popular way of tapping into untamed equity is with a concept called the cash out refinance, which works particularly well with the BRRRR strategy that we spoke about earlier, where you're purchasing a property that you know is being sold under market value or is being underutilized. You're gonna come in, raise the rents, and just raise the overall value of the property. And this is gonna allow you to utilize the cash out refinance strategy. To be honest though, the cash out refinance can be a concept that's a little bit harder to understand. And this video is more intended for beginners, just a quick overview of how equity works. So if you wanted me to make a full video about cash out refinancing, let me know down in the comments, but I'm still gonna show you guys an example based on my first rental property, which is the duplex I was speaking about earlier. So with that example of the first duplex, I bought it at, remember, 182, and a down payment of 20% on that is $36,400. But with the augmentation of the rents and those strategic renovations, if I were to go and refinance it, I could get about $250,000 for that duplex. When you go ahead and refinance a property, you still need to leave 20% of equity in the deal. So in this particular case, if I were to refinance it at $250,000, well, that means that I would still need to leave 20%, so $50,000 in the deal, meaning that my new mortgage would be $200,000. Now at this point, you go and take your $200,000 new mortgage and you pay off your old mortgage, which in this case was, I think, $146,000 if I remember correctly, meaning that you would still have left over about $50,000 in cash that you can utilize to go and buy another property, which $50,000 is well enough for a down payment in my area. So with everything that we covered in today's video on home equity, I hope you were able to learn something, and I want to know down in the comments, what is your opinion on real estate investing? Are you an investor right now, or do you plan on being a real estate investor in the near future? Also, I have had quite a few people comment on my past video about real estate investing that in their area, it's just so expensive to buy real estate. So with that said, if you're not able to buy physical real estate or it's not of interest to you, make sure you check out my video right here about real estate investment trusts, which is a type of real estate investing that you can do straight from the stock market with your mobile phone. So on that note, thanks a lot for watching today's video. I hope you enjoyed it, and I'll see you in the next one.